There's a year that happened long before you existed, 1929. They call it a ghost because it never really left, it just waits. Quiet, patient, until the conditions are right, and right now, it's standing in the room with you. You just can't see it yet, because what actually happened was too embarrassing to explain in full. The richest country on earth destroyed itself in 72 hours. Not war, not famine, a spreadsheet. And right now, that spreadsheet looks identical, just longer. This video will show you exactly how it happened, and exactly why the ghost of 1929 never actually left. By the end of this video, you will understand 3 things that most people never figure out. The real cause of 1929, not the textbook version. The actual mechanism that nobody in power wanted to explain. The 5-step chain reaction that took a bad week on Wall Street and turned it into a decade of destruction, and why that exact chain is loaded and ready today. What the Federal Reserve, the Treasury, and the government actually did during the crash, and how every decision they made turned a crisis into a catastrophe. Before the ghost, there was a party. 1920s America. The Roaring Twenties, jazz clubs, flappers, the Ford Model T rolling off the assembly line, electricity in homes for the first time, radio, the telephone, moving pictures. America had just won a world war, the economy was exploding, and everyone, absolutely everyone, wanted a piece of it. Here is the number you need to hold in your head. Between 1920 and 1929, the Dow Jones Industrial Average went up 500%. 500% in 9 years. If you had put $1 into the stock market in 1920, by 1929, you had 6. So what did Americans do? They put everything in. Savings, inheritance, money they had not earned yet. And when they ran out of their own money, they borrowed. This is where it starts to get dark. In 1929, you could buy stocks on something called margin. You put down 10% of the price and a broker lent you the other 90. Think about what how that means. You have $100. You buy $1,000 worth of stock. The stock goes up 10%. You just doubled your money. Magic, right? Now think about what happens when it moves in the other direction. The stock drops 10%. Your broker calls, you owe him the full loan right now. You have nothing left. You are wiped out completely. That is called a margin call. And in October 1929, every phone on Wall Street rang at exactly the same time. Step 1, the bubble. By 1929, stock prices had completely disconnected from reality. Companies were valued not on what they actually earned, but on what people believed they would earn someday. Speculation had replaced investment. The market was a casino, and nobody wanted to admit it because everyone was winning, until they weren't. Step 2, the trigger, September 1929. The market starts to wobble. A few smart money investors quietly begin to sell. Prices dip slightly, nothing dramatic. A correction, people said, healthy even. But the dip triggered something automatic and merciless. Brokers began issuing margin calls, demanding that borrowers put up more cash to cover their loans. The borrowers did not have the cash, so they sold stocks to raise it, which drove prices lower, which triggered more margin calls, which caused more selling, which drove prices lower still. A loop, a death spiral, and once it started, nothing could stop it. Step 3. Black Thursday, October 24th, 1929. 13 million shares traded in a single day, a record that would stand for decades. The ticker tape could not keep up with the volume. It ran 2 hours behind actual prices. Investors across the country were making decisions based on numbers that no longer existed. Panic. Pure, absolute, unstoppable panic. 5 days later, Black Tuesday, 16 million shares. The market lost 14% of its value in a single session, in a single day. Step 4, the bank runs. Here is what most people miss about 1929. Most people think the stock market crash was the disaster. The stock market crash was not the disaster. The disaster was what happened next. When the market collapsed, ordinary people panicked and ran to their banks to withdraw their savings. But the banks did not have the money. Why? Because the banks had taken their depositors' savings and invested them in the same stocks that had just become worthless. 9,000 banks failed in the United States between 1929 and 1933. 9,000. Every one of those banks held the savings of ordinary people, not investors, not speculators, farmers, teachers, factory workers, people who had never owned a single share of stock in their lives, destroyed by a system they never chose to participate in and never fully understood. Step 5. The Great Depression. When the banks failed, credit vanished. When credit vanished, businesses could not borrow to pay their workers. When businesses could not pay their workers, workers stopped spending. When workers stopped spending, businesses collapsed. When businesses collapsed, more workers lost their jobs, which meant less spending, which meant more collapses. A loop again, but this time pointing all the way down. By 1933, 1 in 4 Americans was unemployed. GDP had fallen by 30%. A quarter of American families had no income whatsoever. Soup kitchens stretched for blocks in every major city in the country. Men who had been millionaires in 1928 were selling apples on street corners in 1932. This is not ancient history. This is what happens when a leveraged financial system, a system built entirely on borrowed money and borrowed confidence, loses its faith in itself. It does not slow down gradually. It does not correct gently. It collapses. Now here is the part of the story that should make your blood run cold. Because the people who were supposed to prevent this did not just fail. They actively made it worse. The Federal Reserve. This is where that story actually begins. In 1928, the Federal Reserve raised interest rates. Their goal was to slow the speculation on Wall Street. What actually happened? Higher rates made it more expensive for businesses to borrow. Economic growth slowed. And when the crash came, instead of cutting rates to inject liquidity into the system, the Fed raised them again. They were terrified of inflation. They chose the wrong enemy at the worst possible moment in history, and millions of people paid for that mistake with everything they had. The Smoot-Hawley Tariff. In 1930, Congress passed one of the most catastrophically misguided pieces of legislation in American history. The Smoot-Hawley Tariff Act raised import taxes on over 20,000 foreign goods to record levels. The theory was simple. Protect American jobs by making foreign products more expensive. The reality was immediate and brutal. Every major trading partner retaliated. Global trade collapsed by 65% in 3 years. American farmers, who depended on export markets, were obliterated. Companies that needed imported raw materials shut down entirely. A recession became a depression. A depression became a catastrophe. And a catastrophe became a decade. The bailout that never came. Here is the critical difference between 1929 and 2008 that nobody talks about. In 1929, there was no FDIC, no federal insurance on bank deposits. When your bank failed, your money was simply gone, permanently. No recovery, no compensation, no safety net of any kind. The government watched 9,000 banks fail and did almost nothing. Compare that to 2008, when the government distributed $700 billion to the very institutions that caused the crisis, while ordinary Americans lost their homes, their jobs, and their retirement savings. 2 different disasters. 2 different responses, the same result for the people at the bottom of the pyramid. The institution was saved both times. The people inside it, not so much. Here's the thing about 1929. We talk about it as a closed chapter, a historical event, something that happened to different people in a different world operating under different rules. It is not a closed chapter. It is a template. Look at what caused the crash of 1929, and then look at where we are today. Asset prices completely disconnected from underlying economic value. In 2024, the price-to-earnings ratio of the S&P 500 reached levels not seen since the dot-com bubble of 2000. in some valuation metrics, higher than 1929 itself. Massive borrowing to speculate in financial markets. Margin debt on U.S. markets today exceeds $800 billion. In 1929, adjusted for the size of the economy, the leverage was smaller than what exists right now. Every single structural condition that made 1929 possible and made it catastrophic rather than merely painful exists today at a larger scale, with higher numbers and fewer safety valves. The leverage is higher, the debt is higher, the disconnection between asset prices and economic reality is arguably higher. The political dysfunction is measurably higher, and the capacity of the government to respond, given the debt load we have already detailed in this series, is significantly lower. The ghost of 1929 does not haunt Wall Street from the outside. It has a permanent desk on the trading floor. It shows up every single morning, and it has been very, very patient. I want to be completely clear about something before we close. This channel is about understanding the system you live inside. Because if you do not understand the system makes decisions for you. And historically, those decisions do not favor the people who were never given the manual. When you borrow to invest in stocks, in crypto, in real estate, in anything, you introduce a mechanism that can wipe you out completely on a move that would otherwise just be uncomfortable. The market can be wrong for far longer than you can remain solvent. This is not theory or philosophy. This is what happened to millions of ordinary people in 1929. It destroyed them in weeks. It will happen again. In 1929, stocks were being discussed and purchased by shoeshine boys and taxi drivers and housewives, people who had never invested before and had simply heard that stocks only go up. By the time an asset class is the topic of dinner party conversation, the sophisticated buyers who moved in early have already started positioning to exit. The question is never whether something will crash. The only question is who is holding it when it does. One of the most counterintuitive lessons of 1929 and 2008 is that the people who came out best were not the ones with the cleverest investments. They were the ones who had cash. Because when everything is falling and everyone is being forced to sell, cash is the only thing that retains purchasing power. In a deflationary collapse, holding cash is not a failure of ambition. It is the trade of a lifetime. In 1929, the banks failed and the people lost their savings. In 2008, the banks were rescued and the people lost their homes. In both cases, the priority was the preservation of the financial system itself, not the welfare of the citizens who funded it, worked inside it, and trusted it. This is not cynicism. This is the documented historical record across a century of financial crises. Build your understanding of your own finances on that reality. After the worst financial catastrophe in American history, after a full decade of depression, after unemployment at 25%, after the complete collapse of the banking system, the United States rebuilt. The economy recovered. New regulatory frameworks were constructed. New institutions were created. A generation of people who had lost everything adapted, rebuilt, and created the most prosperous era in American history. The crash of 1929 was not the end of the American economy, but it was the end of a particular version of it, a version built on illusion, on leverage, and on the collective belief that asset prices could rise forever. Something was destroyed, and something entirely new was built from the wreckage. That is always the shape of the story. The question is never if, only when, and whose wreckage.